Hey, I think let's get started. If there are people who want to join in, they can always do so. Those who are registered should be able to join in um, as we start off. So thanks for joining in. So today's session, we are going to be talking about how we protect our portfolio, and there's a lot that you can learn from our framework. Though our framework is applied to a hedge fund, a lot of the things that we're going to be talking about can be used in your individual portfolios, or if you are looking to invest in certain stocks, etc., how you can analyze, how you can use this, pretty much usable for a lot of other things as well, right? So first of all, no financial advice. No part of this presentation is financial advice. Information is presented based on market and investment research. Please consult your financial advisor before making any investment decisions. Even for the people who approach us for investments, we do refer them to various financial advisors if they need help with any of their investment decisions. This presentation is suitable for sophisticated and professional investors, as well as qualified institutional buyers. It doesn't constitute an offer of securities, and no solicitation of investment is being made. Right. A quick suitability and risk statement. Suitable, the kind of investment that we are doing, it's suitable for sophisticated investors, professional investors, and qualified institutional buyers. Hedge funds are unregistered private investment vehicles. Typically, they are they're suitable for somebody with discretionary capital set aside strictly for a sort of speculative investment. Investment in hedge fund is not suitable or desirable for all investors. Only qualified eligible investors can invest into hedge funds. So that way, we would like to set who can invest into our fund, but a lot of the insights that we will be sharing is things that you can take and you can apply to your investing chart. So that's our agenda for today. I can see Mehul joined. Hi, Mehul.
Hi, Somi. How are you?
Hey, yeah, all right, right. Oh,
Yeah,
thanks.
so we've been having a lot of activity on the other group, as some of you are aware. Yeah.
Yeah. Good to see you around, Mehul.
Welcome, Somi. Pleasure to be here.
Sure, thank you. So we'll start off with a brief introduction on who we are. We'll talk about the risks that we are exposed to as a hedge fund, as a general partner firm, why portfolio protection matters, that too particularly in a year like this when it's quite volatile. And I also have our COO Sridhar along with us, and and you know basically between us we kind of run at pretty much of a tightly controlled ship in terms of how we manage the portfolio and how we protect the portfolio going forward. Um, we'll talk about our risk framework, the core principles that we use. And again, it's not going to be a lot different from what you see from various other investment vehicle presentations, etc., that you will see. But how we apply it, because we use a layered protection model, we're not applying all of the protection at the same level, at the same scale and size. So we're using basically a layered protection. And I'll also talk about a dynamic risk engine, HDI2, and these and basically the signals that are issued by our risk engine HDI2 and how it has worked in the last 6 weeks. What we have done, we will talk about some of these sample trades. We'll talk about the ESG and the reputational risk related filters that we use. our governance and oversight, and at last we'll do a summary and Q&A. So expect about 45 minutes, 45 minutes in terms of presentation. We can take questions at the end, or if you have a question in between, just raise your hand. We can always answer that in between. Who are we? We're Helix Research. We are a general partner firm. We work in the private capital markets. Unlike asset managers who are working in the public capital markets and generate mutual funds, etc., we are in the private capital markets. So largely we work with high net worth individuals, family offices, a handful of institutions, as well as a number of professional investors and traders. We run a hedge fund, and we also advise companies on finance matters. We are a strategic financial advisor to a large European infrastructure firm, and we help them in their smart city projects across Europe. So that is us. Just to continue on that, many of you might have seen our website, and we find that Helix has absolute returns that are very high, but that is not why we are awesome, right? And I obviously need to drum up some attention over here about what we did in the last 6 weeks. On Liberation Day, when Trump goes and basically announces those tariffs, etc., the S&P 500 had a drawdown of 17.2%. Right, most of the portfolios dropped anywhere between 15 and 20%. Many of the funds dropped 15-20% on that one single day, right? But for us, we had a drawdown of 4.1%. So we limited that. That's one major area in the last 6 weeks that I'd like to talk about. Secondly, we are uncorrelated with the market, meaning whether the market goes up or down, our returns remain higher than the market. Thirdly, and more importantly, we have a win rate of 75%, and that is where HDI2 plays a big part, because our system identifies and gives the signal, not the noise, right? So with that win rate of 75%, we can always say win rate doesn't matter. Even with a win rate of 51%, you should be doing really well. No, but then I advise you to look at the win rate in conjunction with a profit factor. We have a 15 times profit versus the losing trades, right? So more importantly, our thesis is available as a book. So if you'd like to follow our thesis, go ahead and buy the book or get it through your library. Start following it. Start following the insights in that book. Analyze your investments based on that. Go ahead and implement it. We write every week. We also go live every Tuesday at 11 o'clock. You can see how things are working. So it's pretty much like, if you want to ride the car, you got to pay for it. But if you want to learn about, how this car works and how you can use it and how you can build your own car, go ahead and use it. All of that is transparent, basically a glass bonnet on the engine, so you can see how the engine works. We also help companies going green by using cheaper finance. And this might appear as a contradiction, because a lot of times we hear the fact that going green means a huge expense. In fact, the Daily Mail likes to write about it, and they basically like to say that it's basically a sort of a losing proposition. Unfortunately, that is not the truth, right? We've helped so many companies use cheaper finance and go green, and they are also seeing a much larger market because of that. Most of these interventions are in energy, buildings, water, waste, and various digital technologies that companies are coming up with to help manage energy, to basically to reduce emissions or to conserve water, choosing a different source of industrial heat, etc. Right? Okay. So our portfolio is exposed to various risks, just like any other portfolio, but we are also exposed to a few risks more than that. Right? Number one is concentration risk. Because what we are doing here is we are focusing on a set of companies that are equal leaders, and we are investing into those, and there is a significant concentration risk associated with that. So in spite of how we diversify, we have to manage concentration risk on a sort of day-to-day basis. Secondly, one of the other risks that we are specifically exposed to is the fact that what is eco? That definition keeps changing in the market every now and then. And that is one of the reasons why we have our own model, and that is published as a couple of books. Because our model doesn't change because the European Union wants to slightly make it easier for companies to go green, or the fact that basically the US decides that I don't want to do anything ESG anymore. Our model does not change because of that. We use a consistent definition and we use a consistent model in order to use this. We use a signal-based execution, and you can basically subscribe to these signals as well. So any signal-based execution is exposed to model risk. So I'll also talk about how we manage that model risk as we go on. And because we are thematic, meaning we are focusing on a particular theme, etc., there could be short squeezes in the market based on that. And this has happened a lot in the last, I would say, 6 months, 6 to 8 months, and since about October. So there have been quite a few cases of short squeezes in the market. That is particularly because a number of institutions are sellers, and we have a number of individuals who are trying to buy the dip, right? We also have, obviously, every investment portfolio is exposed to market risk. So any macro events, any interest rate decisions, etc., can disrupt our portfolio. ESG misalignment. We are not ESG really. We are more forward-looking ESG, and I would say we are more of the capitalistic side of ESG. But the fact that a company is ESG rated exposes it to a higher level of reputational risk, and we'll talk about that as we go on. Okay, we talked about what are the risks that we are exposed to. Now I'll talk about why portfolio protection matters. So I could go on and say, okay, because we've basically designed a fund of this type, etc., and our returns are high, that's it, chopped up, right? But here is the truth behind it. Whenever drawdowns happen, drawdowns are not an actual loss, right? So you enter a trade and you find that maybe you went long on a particular security, and then you find that prices declined by 1% or 2%, but it does not hit your stop losses yet, right? But at that point of time, if you value your position, you have a drawdown at that point, basically at that point, right? Now, in a lot of cases, you can't avoid it, but you can limit it. And that's one of the reasons why we always say managing drawdown is very, very important if you want to generate any returns at all. Because all the returns that the portfolio generates could vanish because of unmanaged maximum drawdown. And unfortunately, drawdowns are exponential, right? So when your S&P declined 17.2% on April 2nd, a lot of news in the market was that it would bounce back and it would go back in the next day, etc., etc. Yes, and it did go back another 4%, etc. It will go back, but then it is exponential in nature. What you lost in a single day, it takes more than a year to kind of recover. So managing drawdown becomes very, very crucial in order to manage a portfolio very tightly. And like it or not, ESG rated securities, sustainable investing is much more volatile than all of the other traditional investing that we see. And there's obviously a reason behind it. There is more attention towards a firm that is ESG, and it also adds additional reputational risk. Call it greenwashing, call it whatever. But unfortunately, any firm, whether they like it or not, the moment they have an ESG rating on their securities, or even in fact, the fact that a company introduces a sustainability or an ESG section on their website, they are exposed to more reputational risk, right? We'll talk about our capital preservation methods as we go on, but very, very key is how we manage drawdowns and how we keep that under control in order for us to generate uncorrelated returns. So first of all, what are we investing in? There is this aspirations gap, which is younger generations aspire to live a digitally interconnected, sustainable life, but the market doesn't provide it, right? This aspirations gap is growing at about 30% year on year. And that is the space where we operate. So those companies that fill this aspirations gap, they are hyper profitable. They have the best kind of customer acquisition cost, lowest customer acquisition cost, and the highest lifetime value from customers. Even the big brands that specifically focus on the under 30s, they find that because of the growing aspirations gap and their ability to meet that aspirations gap, their profits in that particular segment is significantly higher than all the other segments as such. And that is where we kind of focus our energy. We use this model called ecoeconomics. It's available as 2 books that I've written, came out last year. But fundamentally, what we're looking at is a triangular relationship between financial, social, and environmental sustainability. And with that, what happens is these companies are, while we had somewhere close to about 1,000 odd listed companies that dropped out of the radar in terms of climate commitments, ESG commitments, etc. But then ignore them. Look at those companies that have been highly profitable and sustainable at the same time. We will, what we found was that I didn't invent this framework. I observed it in the market and I basically started writing about it. What we saw was that many of these companies have sustainability inbuilt into the strategy, and they've been doing work on sustainability since 2010, 2005, 2000, whatever, right? Several decades of work that's been done. And even the ones that are starting off, that have started off in the last 5-6 years, they've embedded it very closely within their strategy. And what we've observed is the fact that ecoeconomics and this particular triangular relationship creates a moat that makes the company very, very resilient, right? And if we are able to identify those stocks, basically select those stocks and invest in those, the moats are significantly large enough to manage the risk that the firms are exposed to. We also use enhanced portfolio hedging, and we'll talk about how we hedge the portfolio, how we are looking at various sectors. We are hedging from a geography, industry sector as well as a company business model perspective. There are basically 3 levels of hedges that we use, right? And our method of diversification is quite different in the sense that we are not diversifying for diversification's sake. We're taking some strategic bets in terms of how we diversify, right? So that's our sort of layered protection model that we use. I think I mentioned this right at the start. It is not just one layer of protection that helps. It is multiple layers, and the fact that it is layered is what basically helps in terms of protecting the capital over the long term. Number one, we are selecting stocks that have high free cash flow, pretty high return on invested capital, low leverage, and a high moat, right? Those are the sort of stocks that we are selecting as part of our core portfolio, right? Diversification, I talked about the sector, geography, and basically within the sector, various companies that we're looking at, etc. We've got about 60 plus stocks that we invest into. Our hedge fund uses basically 4 strategies. There is core, the satellite 1, satellite 2, and then we use and we also use an overlay. So think of it as, in the sort of mutual fund context, you can think of it as 4 different mutual funds masquerading as one, and within those 4 mutual funds can basically have pretty much of a dynamic allocation. So I could go long short, long short, long short on each of these strategies, and that's the way this engine works, right? And how we size the positions. We can't get a 15:1 kind of profit factor without the right kind of position sizing. So each of our signals, our HTA2 engine would tell us what is the maximum amount of capital that I can commit at the start, what is the stop loss, and then how much I can scale, right? It is not going to let me scale beyond a certain point, but then within that particular scaling limit that I have, I can go scale a number of times. I can scale, I'll talk about some of the examples that we have in the last 6 weeks. Some of these we've scaled 72 times. So we've scaled up, book profit, again, scaled up, book profit, etc., again and again, right? And because we use a signal-based execution, the model is kind of detached from the actual trading. So a lot of the emotional conditioning comes from the fact that we're using signals, right? We are not going to be dependent on how this particular chart looks like and whether this particular pattern is there or the signal tells us what to do. And that signal is calibrated. It is, you can kind of imagine this like, if you're working at a large bank, you have the risk department sitting right next to you and telling you, hey, look, you can't do more than 1% of this. That's what you can do, and this is your is a kind of downside protection that you must have on every single trade, right? That's how this works. We are both long and short, and because we are short, what we find is that in the equity markets, the short book is likely to undergo more drawdown than the long book. Unfortunately, that is a reality of the equity markets, and that is why we need both structural as well as tactical sort of hedging, specifically for the short book alone, right? We use liquidity buffers. We typically kind of use the treasuries. We use treasuries. We use tips as methods to kind of just kind of manage liquidity. At some points, we might have up to about, let's say, 30% cash buffer, and at some points we might have like 5% cash buffer or even 1% cash buffer. So it's not only cash buffers that we are dependent on. We are using multiple liquidity buffers in order to handle this. And obviously, because we are using leverage, it's very important to manage liquidity buffers as we go along. So that's our engine, HCI2. What it does is it takes macro overlays. It does risk monitoring for us. It issues the signals based on this. What we do is, instead of rebalancing, use a quarterly rotation. So I talked about, core, satellite 1, satellite 2, and then overlay portfolios. The HTA2 engine does this intuitively. It tells us, okay, from this day onwards, reduce your exposure onto core, go into satellite 1, into satellite 2, use the overlay, etc., right? Makes these market sensitive adjustments for us, right? How is it built? We can do a different, entirely different section on that, but it's basically a risk engine operating at the back. It makes sure that our portfolio is optimized for the value at risk, the Sharpe ratio, the Sortino ratio, and the drawdown effectively monitored every single day, very closely, and it kind of recalibrates based on whatever trades that we have done. We go and dump it into the signal log. So based on the signal, these are the executions, these are the positions that are still open, etc. So we can pretty much monitor that, and we can recalibrate the signals going forward, right? And that's the engine that issues the signals. Goes on to our Discord channel. So for subscribers who are using it, there are a few prop firms that also use this particular signal in order to execute. On basically, they issue it to their traders to follow in terms of how they can use this in order to trade more carefully and more closely with respect to how market is moving, right? So here are a few sample trades in the last 6 weeks. Goldman Sachs, April 4th onwards, we're still open on that. We've scaled that position 72 times so far. Scaled up, down, up, down, up, down, book profits, come back again and again. It's about 72 times that we have scaled. So they're best positioned in driving sustainable finance, right? While a lot of the news will tell you Trump is going anti-ESG and most of the environmental stuff is all gone, done and dusted, most of the companies, no, that's not true. Because Trump can't do anything with it, because most of the environmental regulations in the US are state level, not federal, and Trump can't go and change it. Most of the incentives are at the state level, and they are not at the federal level. The news will not tell you this, right? So we took a stand on that, and we entered Goldman Sachs 467, currently 568. We've scaled that position 72 times so far, and we continue to hold this one, right? ExxonMobil. Some of you might come back and say, ExxonMobil is a fossil fuel company. Why do you want to invest in it? Because you're eco, you're ESG. I'm not ESG, right? And I'll tell you what, I'm actually anti-ESG. We are more ESG on steroids. We are more ESG that is forward-looking, not report-looking. And from our perspective, we don't use this blacklist, whitelist kind of a concept. We look at it from underneath, under the hood, how it is working. It is a fossil fuel company, but crucial transition technology is dependent on that. Hydrogen, number one. Carbon capture, storage, utilization technology depends on that. They've made huge investments in this space. Gas to liquids, dependent on that, right? There was a signal issued April 2nd, 118. It closed at 101 on April 7th. That was short, basically. But we'll reopen long because they are undervalued. as per our analysis, they are undervalued, and we are likely to open long when the price parameters kind of fit that criteria, right? Then the next one I want to talk about is Booking Holdings. We all know Booking.com, but that's not the only thing that Booking does, right? They've got internet real estate and travel, hospitality, experiences, price comparison. Kayak is also Kayak, or I think Kayak, yeah. It's also owned by Booking. So best positioned in the experience economy in comparison to Airbnb and various other ones. They have the best financial metrics, right? April 7th, long signal at 42.35. April 30th, we closed at 50.86, right? That's about $800 profit on a single share, right? So, and of course, we can go up to about, right, 100,000 shares or whatever at a point of time. So our scales are much, much, much higher, with respect to this, right? Lennar, right? They're basically a house builder. A VC that I spoke with earlier, they said, why Lennar? They're not building anything fancy. They are building box standard housing. That is the housing that is needed, right? It is not luxury apartments. It is not luxury homes, or maybe condos and whatever that is unaffordable to mass part of the population. But these guys are meeting the aspirations gap, because meeting the aspirations gap needs great housing, right? It's not luxury properties. It's not styled kind of villas or whatever. Box standard housing, cookie cutter sort of a place, accessible to ones who aspire to buy it, right? Entered at 100, closed May 5th, 110. We will continue to kind of monitor this. We will go, and I think we scaled basically within this particular time, we scaled about 30 times, basically within this particular period, right? I'll talk about some of the risk filters that we use. ESG rated means that they're exposed to higher reputational risk. As I mentioned, even if a company is adding a sustainability report onto their website, or if they're talking about sustainability on their annual report, the moment some analyst firm or research firm basically senses that there is a eco premium on that particular stock, right? Stock, bond, both ways, right? There is a eco premium. What it does really is the fact that it inflates the asset prices. And from the company's perspective, largely, I would say ESG has been a reputational burden to manage, right? So what we are doing is we are using forward-looking ESG, right? And we cut the G, because we say the G, basically the governance has to be in place, whether you like it or not, right? Whether you want to be in business or not depends on whether you have the right governance in place. So we take the G out. We are only looking at the environmental and social, and whether that is adding to the profitability of that company. So it's a capitalistic side of sustainability, and we discount using margin of safety, and that's a concept called eco-MOS, eco margin of safety. It's a key concept in ecoeconomics, and that becomes pretty much of a risk filter for us, how we can select these. Many companies would fit the bill as high profitability, great stuff on free cash flows. Free cash flows, great, but if you're constantly buying back shares, I would discount them. I wouldn't take them, right? And basically the reason for that is, if the company is buying back, it gives me the signal that the company is telling me, I don't have anything more to invest in my company. So that's the reason why I'm giving you back the money. What do I want the company to do? I want the company to take my money, make more returns on it, right? Not give it back to me and say, you go invest in bonds. That's not what I want, right? So, dividends, fine, great. But that's exactly not why I'm investing in. I'm investing in this for capital appreciation, right? So that's the key behind ecoeconomics. So if you've read the book, if you've been using it, you'll find that the margin of safety concept is weaved into each and every section within that, and how we use eco-moss as a sort of risk filter, right? So governance, oversight, transparency, what we're doing. There's an investor letter available on our website, so you can go read that. We can see how things are going on. Our performance reports are available on our website, so you can see what our trades we're taking, how we are using the signals, etc. Whether we are doing really well. What is our sort of margins on a sort of day-to-day basis? We upload the trades that we have done, so we can pretty much see that. As I said, book is available. Buy them or get it through your library, or your you have access to a university, and most of the universities in the UK also have access to these books. Read them, use it for your own benefit. Our research is available every week. We are live on Substack every Tuesday at 11 o'clock, talking about the changes that we are making. So our COO pretty much runs it as a well-oiled machine. So it's kind of closely monitored, tightly controlled sort of a machine. Our chief of staff ensures that all the communication, including this particular presentation, is fit for proper and is basically right in terms of the sort of authorization that we have, right? And our board of directors meet quarterly to see how we are doing, making any strategic changes, looking at the market. Are we doing the right things right now? Yeah. A quick sort of summary: aspirations gap, material in the investment world. It's been material in the real world economy for at least 5 years. It's now quite material in the investment world. Ecoeconomics is a capitalistic side of sustainability, not the usual sustainability. I'm not an idealist, right? I'm not going to come here and say we got to compromise profits for being sustainable. So no, that's not my view. You have to be profitable and sustainable at the same time, right? A lot of times we find that mutual funds, ETFs have drawdowns that are 35%, 20%, 30%, 35%. And in most cases, unless you're looking at the X-ray of the fund every single day, you'll have no clue of it, right? So drawdowns are real, and drawdowns are exponential, right? In such kind of active markets, such kind of volatile markets, basically active management is necessary. So while there is a time and space for passive management, this is not one of those, right? If you're passive, you're probably going to see large drawdowns any which way, right? It'll take a few years to kind of recover from single-day drawdowns on the S&P 500, and that's one of the reasons why we find institutions taking. You can learn a lot from seeing how these institutions trade, right? When the single-day drawdown happened, until now, we find many of the institutions make block trades that are sell, not buy. They're not buying into it, right? Why are they doing that? They are protecting their own capital and the capital of their largest investors, not you, not the retail investor on the street, right? By all means, stay invested, but know what you're investing in, know how it is being managed, etc. Right? I'll stop the presentation at this point. As I said, it's about 40 minutes presentation. I'll stop at this point. Happy to take any questions. Yeah.
Yeah. Hello, Swami. Thanks
Hi,
for all
Ritesh.
the. Yeah, thank you for all the very useful information. Just quick
You're welcome.
thing. So I've got like my pension pot and also some ISA. Is there a possibility to kind of start using this fund, like Helix fund, through those channels?
Because it is a hedge fund, it's not available through an ISA. But we are registered through an FCA authorized broker asset manager. So for those who want to invest in the fund, you can either go through the registered broker, or you can sign up through our own. We use basically a limited partnership approach. Basically, a limited partnership agreement. We take that and we register it with the broker, and we basically manage it through that. Or otherwise, you can go on board directly onto the broker itself, right? But it's not available through an ISA. Because ISAs expect the fund to be listed essentially, right? That's not the case with us. Yeah, we are a hedge fund as such.
Okay. Yeah, thanks, Somi. Thank you.
Sure. Any other questions?
Hi, Somi. This is Akhil.
Hi, Akhil.
Hey, hi. Apologies, I was a bit late. I just landed late last night. But once again, thanks for an amazing presentation. And you may have covered this at the start. I joined with your layered protection section. But as you look forward next 6 months, what's your view on US vis-a-vis China and the other markets? And people saying capital flows are moving back and forth. I mean, and the reason I say 6 months, I mean, I'm a long-term investor, so 6 months is kind of not really there. But I'm thinking of portfolio allocation. What's kind of your view?
We published our research saying that the US economy is likely to decline this year, and the possibility of a US recession is quite high, right? While other research houses say somewhere like 60% likelihood of a US recession, we don't want to put a certain likelihood behind it, but we can pretty much say that it is kind of a manufactured recession, right? The economy was not in a structurally weak sort of a situation. It would have grown better had it not been for basically a flurry of executive orders and tariffs, retaliatory trade stuff. It would have stayed afloat, right? So it's kind of a manufactured recession. So such manufactured recessions are likely to linger along a little longer than those that are more natural, right? That's one big risk that we kind of run. Secondly, if you look at the Fed's stance more recently last week, both the Fed as well as the Bank of England chose to keep interest rates as is, and that is because of what we call a sticky inflation, right? So central banks are largely looking at goods and services inflation. They're not really looking at asset inflation, but well within the basically within the the goods and services inflationary space, we are seeing sticky inflation, and that's one of the reasons why both large large monetary authorities have decided to keep interest rates as is, right? What is likely to happen, as we see, is when the possibility of a US recession is high, because of our interconnectedness, many other major economies are also likely to experience recessionary forces. Whether it would be a global recession or not, we can't say at this particular point of time. We still need a lot more data to say that. But the risks are real, right? And the inflationary stance is real, right? And you can kind of read that from what the major monetary authorities are telling us: the Bank of England, ECB, the Fed, right? What they're telling us, that kind of tells us pretty much the view that this is heading where it is, right? While with the kind of structure in which where we are currently, basically the market situation is that most of the institutional sales over the last 6 weeks, 6 to 8 weeks, has been that institutions are net sellers of stocks, right? And it is not only in the US, it is here in the UK, across Europe as well. So what we see in the market is you have institutions that are net sellers, and there are a number of retail brokerages that are booking orders for their retail clients, thinking that they are buying the dip, right? Unfortunately, the bottom is not where we are at the moment, right? So this is the sort of situation where more close attention is needed in terms of where you invest, and as I said, by all means stay invested, but know where you invest and how the risk is managed over there. And yeah, thanks, Nisar. Thanks for letting me know. Yeah, the BOE did make a slight reduction, but their stance is that they want to monitor this sticky inflationary situation going forward. The ECB is also talking about the same thing. They want to closely monitor the sticky inflation, because one of the risks of aggressive aggressive policy stance is that it would only drive asset inflation. It wouldn't really reduce the goods and services inflation as such. And that's one of the reasons why basically the central banks are doing that, measured stance, with respect to the interest rate decisions. We also need to look at I always say this again and again. I say the US produces a lot of data, not necessarily the right data, but if you just look at things like unemployment data, we here in the UK produce much better quality data than what we get from the US. In the US, we get a lot more data, but not necessarily good quality data. So with that, again, it takes a few months to a few quarters for unemployment to catch up, right? And as we see real results in the economy, that is when we would know what really happens, right? So my view is stay invested, but choose to invest in assets that are well managed, well risk calibrated, right? And I think that is pretty much very, very important in this kind of a market.
Yeah, thank you so much.
Thanks, Akhil. Any other?
This is Nisarg here. Very quick question.
Hey. Yes.
Hi. First of all, sincere apologies. I had a clash, so I was late in joining. But the portion I heard was extraordinary, very good. So thank you for sharing all these interesting facts with us. In terms of hedge funds, how do you manage? Let's say there is suddenly all the investors they have fear, right, in the markets, and if suddenly there's a liquidity stress on the fund, what kind of tools the industry employ, and particularly your firm would deploy to ensure the liquidity stress doesn't impact those investors who do not want to exit? That's the question.
Right. Yeah. So one of the things that we've been doing is basically this sort of core satellite and overlay kind of a strategy with cash buffers, with liquidity buffers as such, right? And some of the overlays that we use also act as effective hedges when such kind of liquidity squeezes happen, right? So so we take the Eurozone into account. While our predominant market is the US market, we tend to take the Eurozone, we tend to take Asian ETFs as overlays. We tend to take basically the Euro bond ETFs. So we kind of use that as overlays to kind of manage liquidity. We basically have a 2-day redemption policy on our hedge fund. So if anyone wants to redeem, they can obviously redeem at any point of time. So in order to manage something like that, it's very important for us to manage the liquidity buffers. And some of the investors that we work with, they've been with us like 15 months right now since our inception. And some of them have kind of joined us more recently. But again, the level of transparency that we provide and the fact that they are able to understand, and they're able to pick up the phone and talk to us very quickly if they have a question, right? That makes it a lot easier, right? In the market, it's not so much about, I would say, making a redemption at this particular point of time, but understanding what we do and how we manage things. That is becoming very, very crucial for investors right now, right? Having access to the the GP firm and basically the managing partner itself, pick up the phone, talk to them, find out what are you guys doing, what is happening right now, why this particular trade, why, and again, our performance is also available directly on our website, and basically investors are able to see that and say, okay, fine, why this particular trade went for a toss, right? And we can obviously explain that. We can go through that pretty quickly. So with that kind of an approach, it's been, I would say, reasonably okay. Not to say that markets are not tough. It is a tough market to be in, and because we are a hedge fund, we are constantly fundraising. We are constantly adding more and more investors. So there's obviously a situation where we're doing due diligence with one firm while another firm is looking to ask us more questions and whether to kind of increase or increase that allocation to us, right? That's always the case.
Sure, thank you. That helps.
Any further questions, or we can close the call? Okay, if there are no other questions, I'll close the call. Thanks for joining in. I'll be posting the recording soon, probably tomorrow. You should receive the link with the recording. So if you're registered, couldn't attend the full session or whatever, you can always go back and watch the recording. Yeah, right. Thank you.
Yeah, thank you so much. Thank you.
Thanks. Bye.